Why is Europe always lagging behind the US? Economists, decision makers, and academics have long disagreed about the continuous comparison between the United States and Europe. Even though both countries have developed economies, Europe frequently lags behind the US in a number of areas, including technical innovation, economic growth, and geopolitical influence. This video will look at structural, historical, and policy-related reasons why Europe is lagging behind the United States. We can better appreciate the difficulties Europe has in retaining its competitiveness in the global market by comprehending these underlying issues. Historical context. The economic positions of the United States and Europe today are greatly shaped by their respective historical paths. Since it is a relatively new country, the United States has benefited from a period of rapid industrialization and expansion, free from the geopolitical difficulties and historical battles that have defined Europe. The United States was able to take use of its abundant natural resources and expanding population after gaining independence in the late 18th century, which helped to establish the foundation for its rise to prominence in the world economy. On the other hand, centuries of warfare have characterized the history of Europe, particularly the two world wars that ravaged the continent's economy and infrastructure in the 20th century. Western Europe benefited from the Marshall Plan and later economic unification, whereas Eastern Europe continued to be ruled by the Soviet Union, which stunted innovation and economic progress. As a result, the post-war recovery was unequal and sluggish. The economic gap between Western and Eastern Europe continued even after the fall of the Iron Curtain, impeding the advancement of the continent as a whole. Differences in structural economics. Flexibility in the labor market. A significant structural distinction between the United States and Europe is the degree of flexibility in the labor market. Due to its high degree of worker mobility, lax hiring and firing restrictions, and comparatively low unionization rates, the American labor market is renowned for its flexibility. Because of their flexibility, American businesses are able to quickly adjust to shifting economic conditions, scale up or down their workforces as needed, and promote an entrepreneurial culture. The labor markets in Europe, however, are often more inflexible. Strong labor unions, stringent labor regulations, and extensive social welfare programs are common in many European nations. While these systems offer substantial worker protections, they can also make it challenging for firms to adapt to changes in the economy. Excessive job stability and benefit packages may lessen the motivation of employees to take risks or switch employment, which may inhibit economic dynamism and innovation. The regulatory landscape. Compared to the United States, Europe frequently has a more complicated and restrictive regulatory framework. Excessive regulation can impede the growth and innovation of businesses, even while it is vital to maintain fair competition, consumer protection, and environmental sustainability. Europe's regulatory environment is frequently defined by strict laws and regulations that differ greatly throughout the continent's several countries, resulting in a fragmented market that can be challenging for companies to operate in. Conversely, the United States gains from a more cohesive regulatory framework that places more of a focus on deregulation and free market principles. This has made it possible for American businesses to develop and grow quickly, especially those in the technology industry. For example, Silicon Valley has emerged as a global center for technological innovation, partly because of an advantageous legislative framework that promotes investment in startups and risk-taking. Revenue and public expenditure. A further fundamental distinction is the way public expenditures and taxes are handled. Comparatively speaking to the United States, European nations often have higher tax rates and more comprehensive social welfare programs. Although these policies lower income disparity and offer a robust safety net for citizens, they may also cost individuals and enterprises more, which lowers their disposable income and investment potential. The United States has less social welfare spending and a smaller tax burden than other countries, which might increase income disparity but also stimulate more private investment and consumption. Europe has more public spending than other regions, especially when it comes to healthcare, pensions, and unemployment benefits. This can put a strain on government budgets and limit the amount of money that can be allocated to investments in infrastructure, innovation, and education, all of which are vital for sustained economic growth. Research and development, R&D, investment, innovation, and technological advancement. Economic growth is mostly driven by innovation, and when it comes to R&D expenditure, the US has continuously surpassed Europe. American businesses extensively spend in research and development, R&D, especially in the technology and pharmaceutical industries. They receive help from a robust network of research universities, venture capital firms, and government funding. Because of this, the United States is now at the forefront of scientific developments in fields like biotechnology, artificial intelligence, and space exploration, as well as the internet. Despite having some of the top scientific institutes in the world, Europe has found it difficult to match American investment in R&D. European businesses may find it more difficult to innovate due to increased expenses and regulatory barriers. In addition, the European economy is more fragmented, with disparities in innovation and investment among nations, which makes a cohesive plan for technological growth impossible. Ecosystem of entrepreneurs. The United States of America is home to a thriving startup and innovation-promoting ecosystem. The United States is becoming a hotbed of successful startups due to factors including easy access to venture financing, a culture that embraces entrepreneurship, and comparatively low barriers to entry for new ventures. The United States' status as a global leader in innovation has been further cemented by the success stories of corporations such as Apple, Google, and Facebook. Europe, on the other hand, offers less incentives for entrepreneurs to launch new companies due to a more risk-averse society. Venture finance is increasingly difficult to come by, and businesses may find the regulatory landscape difficult to navigate. Europe still lags behind the United States in developing a thriving entrepreneurial ecosystem, despite recent efforts to promote innovation, such as the European Innovation Council and other startup accelerators. Economic and geopolitical impact. Military might and worldwide impact. The United States military might, which enables it to project force and defend its interests globally, contributes to its influence on the world stage. The US dollar's position as the global reserve currency and its dominance in international institutions, such as the United Nations, NATO, and the World Bank, are bolstered by its military might. The United States enjoys a substantial geopolitical influence advantage over Europe due to its capacity to influence international economic and political norms. Europe is a major political and economic force, but its foreign and defense policies are less cohesive and more fractured than they should be. The European Union (EU) has found it difficult to project power autonomously, as seen by its reliance on the United States for military security through NATO and its struggles to maintain a united front on many international matters. Europe's ability to compete with the United States in determining international agendas is diminished by its fragmentation, which also lessens its impact on the world stage. Crisis response and economic resilience. When faced with economic downturns, the United States has proven to be remarkably resilient, frequently recovering faster than Europe. For instance, the United States adopted aggressive fiscal and monetary measures in response to the 2008 financial crisis, which aided in the country's comparatively quick recovery. A flexible labor market, a vibrant financial sector, and the U.S. Federal Reserve's ability to take decisive action all contributed to the economy's stabilization and recovery of growth. In contrast, Europe experienced a protracted period of economic stagnation after the 2008 crisis, which was made worse by the Eurozone's sovereign debt crisis. It was challenging to put into practice a coordinated and efficient reaction because of the EU's convoluted decision-making process and the disparate economic circumstances among its member nations. The imposition of austerity measures on nations such as Greece and Spain resulted in social discontent and impeded economic recovery, hence exacerbating the divide between Europe and the United States. Cultural and social aspects. Trends in demography. The way forward for promoting innovation and entrepreneurship and policy. Recommendations. Europe needs to put innovation and entrepreneurship first if it wants to catch up to the United States. This can be accomplished by boosting R&D spending, streamlining legal requirements, and offering more assistance to new businesses. To create a more competitive and dynamic economy, it will be crucial to promote a culture that rewards innovation and takes risks. This finishes our today's video. Share your thoughts on this in the comments section below. Also subscribe now for more. Thanks for watching.